Welcome back to our channel. This is episode 3 of Investing 101 series. In this video, we'll discuss how to create a strong investment portfolio. Even for novice investors, investing might be intimidating, but it doesn't have to be difficult. We're going to provide you with a beginner's guide to putting together a strong investment portfolio. It's important to understand what a portfolio is before we begin. Simply put, a portfolio is a grouping of investments. A range of investments, including stocks, bonds, mutual funds, exchange-traded funds, and others, can be included in an investment portfolio. A portfolio's objective is to diversify your holdings in order to reduce risk and increase returns. Investing can be a daunting task, especially for beginners. It can be difficult to start when there are so many options on the market. But don't worry, we'll walk you through the process of creating a reliable investment portfolio in this video. Here's a step-by-step guide to building a solid investment portfolio. Take some notes, grab a pen and paper, and let's get started. Determine your investment goals. Establishing your investment goals is the first step in creating a strong investment portfolio. Do you intend to make retirement investments? Do you intend to put money aside for a down payment on a home? Do you desire long-term wealth accumulation? You can begin constructing your portfolio around your investment objectives once you've decided what they are. What kinds of investment objectives should you think about? What do you hope to achieve through investing? Your aims can be straightforward and short-term, or more intricate and long-term. Short-term objectives are typically something you wish to do as soon as possible. As a preliminary estimate, you could say 1 to 2 years. Of course, in terms of investment, this would take a little bit longer than, say, lifestyle goals. Your short-term objectives can be to take a vacation abroad, buy a new car or motorcycle, or renovate your kitchen or bathroom. Long-term objectives are those that will require a lot of time, planning, and work to accomplish. Depending on your goals, this time frame may range from a few years to a few decades. Your long-term objectives can be saving for a down payment on a home, moving up to a new house, buying an investment property, funding the education of your children, accumulating wealth for retirement, or striving for financial independence. Determine your risk tolerance. Determine your risk tolerance as the next stage. Your investment risk tolerance is the degree of uncertainty you are willing to accept. Some people are happy to assume greater risk in the hopes of earning larger rewards, while others favor a more cautious approach. Your portfolio's investments will be chosen based on your risk tolerance. Choose your asset allocation. You can begin selecting your asset allocation once you've established your investment objectives and risk tolerance. The process of distributing your investments among various asset classes is known as asset allocation. Cash, bonds, and stocks are examples of asset classes. Younger investors should generally have a higher allocation to stocks, whereas elderly investors should generally have a higher proportion to bonds. Choose your investments. It's time to choose your investments after determining your asset allocation. There are many different investment options available, but index funds and ETFs are where you should start. A specific market index, like the S&P 500, is followed by a particular kind of mutual fund called an index fund. The ETFs resemble index funds, but are traded similarly to equities. Invest in index funds. Index funds are a fantastic option for novice investors, since they provide diversity and cheap costs. A fantastic approach to obtaining exposure to the stock market is through index funds, which are created to replicate the performance of a specific market index, such as the S&P 500. Diversify your investments. After making your investing decisions, it's critical to diversify your portfolio. Spreading your investments over several asset classes, industries, and geographical areas is what is meant by diversification. Increasing returns while reducing risk is possible with diversification. Monitor and rebalance your portfolio. It's crucial to regularly check and rebalance your portfolio after you've built one. Monitoring your portfolio entails maintaining tabs on your holdings and making necessary corrections. Rebalancing your portfolio entails making changes to your holdings in order to keep your desired asset allocation. Maintaining your preferred asset allocation requires regular portfolio rebalancing. Rebalancing your portfolio means selling some investments and buying others to get it back to the intended allocation. Keep costs low. Investing fees can gradually reduce your earnings, so it's critical to keep expenses minimal. You can increase long-term returns by selecting low-cost index funds and avoiding mutual funds with excessive fees. Invest consistently. Consistent investing is crucial for accumulating wealth in the long run. This entails making regular, predetermined investments into your portfolio, such as once a month or every 3 months. One of the most efficient strategies to develop long-term wealth and financial security is to invest regularly over time, because it enables investors to profit from both market upswings and downturns. Consistent investing helps to lessen the effects of market volatility. Investors can purchase more shares when prices are low and fewer shares when prices are high, resulting in a reduced overall average cost per share. By investing a fixed amount of money at regular periods, as investors commit to consistently setting money aside and adhering to their investment strategy. Consistent investing also aids in the development of good financial habits and discipline. In the end, regular investment can assist people in achieving their financial objectives and creating a more secure future. Avoid emotional investing. Your long-term results may suffer if you engage in emotional investing, such as buying and selling investments based on transient market changes. You can reach your financial objectives by staying committed to a long-term investment plan and avoiding emotional investing. Seek professional advice. And last, it makes sense for novice investors to seek out professional investment guidance. A financial advisor may offer insightful advice and assist you in developing a personalized investment strategy that takes into account your unique requirements and objectives. A strong investing portfolio need not be difficult to put together. You may create a portfolio that satisfies your needs by figuring out your investment objectives, risk tolerance, asset allocation, and diversifying your investments. To make sure it keeps achieving your goals, don't forget to regularly review and adjust your portfolio. That's all for today. Thank you for watching this beginner's guide to building a solid investment portfolio. If you have any questions or comments, please leave them in the comment section below. Subscribe to our channel for more investment tips and advice. Until next time.